Okay, disability insurance. So what is disability insurance? It's an insurance policy that will pay up to 70% of your gross income if you're unable to work because of an illness or injury. Okay? It's up to 70%. Now the reason why 70% is they want to prevent what's called adverse action. Because if I'm a bit, if I got one or two, screws loose, I might decide, I make $100,000 a year, that I'm going to go to 5 different companies, buy a disability policy, if there was no limits to this, and become disabled and claim 5 times my income. So to prevent that, they say the regulators have said that as far as a disability policy is concerned, you cannot have more than 70% of your previous income from all sources. Okay? So whenever you apply for a disability policy, the question always asks, what do you have now, or what are you applying for now? And in the contract, it specifically says that it will be integrated from all sources. So it's redundant to go and get. So hence the reason for the 70%. Because of an injury, very specific, or illness, right? Now, this is an inability to do work, and we'll come specifically to what they're saying there. So what do they mean by injury? Now, I took this off the policy that I'm about to deliver. Someone in their mid-30s just bought a disability policy for me, and I just got it this week. And I'm scheduled to deliver it to this person and go through it with them. And I picked up this definition from a fresh policy, and this is exactly what it said there. Injury means accidental bodily injury. It sounds very circular, right? You're saying injury, but that's what definitions. That's what. So what they mean is something external. Something that's not that doesn't emanate from the body itself. Something violent and external. An injury refers to something that's accidental, right, and external. A sickness, on the other hand, the way they define it, and I can tell you, this insurance company is welcome to my world. It's very circular, the definition. Sickness means sickness or disease. So something that comes from within, right, that started, with the body, as opposed to an accident, right? So if one of these two things occur and you are not able to do your job, the job that you do, then that's what disability insurance is for. So why do we need disability insurance? Because the chances of your becoming disabled before age 65, and why age 65? Because typically people work from age 25, they get out of school in an average till age 65. Those are the working years, okay? The chances of you being disabled for a period of 6 months or more before age 65, if you are 25, it's 58%. There's a 60% chance if you are in your 20s that you're going to be disabled for a period of 6 months or longer before your age 65. Okay? And if you're in your 30s, 50%, 50% chance. In your 40s, almost a 50% chance. So, those are very 1 in 2, 1 in 3. The likelihood. In fact, when you compare these stats to the mortality, the probability of this happening is much higher than you're dying before age 65. You follow? And so that's the primary reason that you get that, because there's a high chance that you're going to that you can become disabled because of an injury or an illness, right? The other reason is we insure everything else. We insure our homes, we insure our cars, and all the assets that we have, the possessions that we have. Why aren't we insuring that which makes all of it possible? We're insuring the eggs, and that's what those eggs, but we don't insure the goose that lays the eggs. Sort of backwards somehow, right? The way I have some brochures here from insurance companies who sell disability insurance. What they'll do is they'll put the brochure in front of you and they'll say, how much did you insure your home for? And you'll put a number, 200,000. Why did you insure it for 200,000? Because it's worth 200,000. Because I stand to lose 200,000 if it burns down to the ground. All right. What did you insure your vehicle for? I insured my vehicle for $25,000. Why? Because I paid $25,000, and if it gets into an accident, I stand to lose $25,000. I have to come up with $25,000 to replace it. So then it comes to the third one. Your income, how much money do you make? $50,000. How old are you? 40 years old. How long do you plan to work? Till age 65. So you're 40 years old, you make $25,000. I was dying to use this. Do you like this, Ronke? $25,000. So you make $50,000. You're 40 years old. You're planning to work till age 65, right? 25 years. So $50,000 by 25 years, without even taking inflation into that's $1.25 million. So your house is worth $200,000. You insured it for $200,000. Your car is worth $25,000. You took the pains to insure it for. You paid $1,000 to insure it. Why aren't you insuring this? Isn't this that makes all of that possible, right? You see? Because it's intangible, because we think it's not going to happen to us, because, we're hoping that it won't happen to us, and that's why we don't. And also because there's a lot of demands on our money, right? Other demands on our money that are more urgent. Types of disability. Let me just make sure I didn't miss anything there. Okay, I didn't. All right. So I hope it provokes thinking on your part as to if you do not have disability insurance, or if you do not have adequate disability insurance, that how important it is. Okay, that the reason why we do this. So types of disability insurance. There's what's called total disability, where due to an inability due to injury or weakness to perform the substantial duties of your regular occupation. Regular occupation by virtue of your education, experience, and training, right? So if you're a nurse, if you cannot, work as a nurse, your regular occupation, that's how they define it, okay? You're not expected to be doing anything unless they specifically define it as such. Okay, we'll come to that, right? Assumed disability, once you've got a disability policy, if you're not able to do substantial, means most of it. It's not, they don't put a number to it, okay? It's always something that's negotiated. There's a lot of abuse in this industry, and that's, they tend to be very defensive for that reason. Because there's a lot of people, they have, they don't particularly like their work, and, they have a whiplash, and they want to go on disability, right? And we've seen a lot of these. And hence, they become very defensive. However, if there should be permanent loss of your sight of both eyes, okay, and I've underlined both eyes, you assume totally disabled, okay? If you lose hearing of both ears, you assume to be totally disabled. If you lose both hands, both feet, or one hand and one foot, you assume to be disabled. And if you lose your speech, you assume to be disabled. A lot of people use their voice, pastors, if they can't speak, it's very difficult for them to preach. People in the entertainment industry, Celine Dion, if her voice goes, imagine, right? So they'll be assumed to be totally disabled. There's partial disability. Once you have a disability policy, it doesn't mean that you have to be totally disabled to collect, okay? If you cannot do, in most policies, if you cannot do 50% of the substantial duties, there's partial disability that kicks in, okay? And so they'll pay you partially, okay, to partially, partial of the amount of what's due to you. Then you've got what's called residual disability, where if because of an injury or illness, your productivity has dropped, okay? You have to go to, you have to take a lot of time off work or off your business to attend to your illness or your injury, and there's a drop in your productivity of at least 20%, then this kicks in. Okay? And what they do is they indemnify you. They put you back in the same position. So whatever the amount of the disability is, you'll negotiate with them to help you out. Now, types of disability policies. Very important when you buy a disability policy is the definition of occupation. Okay? They've got what's called an own occupation definition. They've got a regular occupation definition. Then you've got an any occupation definition. I'll just go through them with you very quickly. In an own occupation policy, it's one of the most liberal ones that you have, okay? And what they mean is, if you're not able to do your own job, okay, by which you are trained to do, you are educated to do, and you have experience in, if you're not able to that specific job, right, but you can do any other job, you're disabled. Okay? Despite the fact that you can do anything else, and you might be even gainfully employed somewhere else. You follow? That for their purpose, you can collect from that policy, right? It's the most liberal one. A lot of professionals have this, because if I'm a dentist and if I cannot, do this, but if I can teach or do something else, then that the disability policy still pays while I'm gainfully employed doing something else, but not my own occupation, right? The one that says regular occupation is the same thing, except that you cannot be gainfully employed anywhere else. Okay, you can only do your own job. You must not be able to do your own job, and you must not be employed anywhere else. Okay. The last one is any occupation. Now, in group insurances and whatnot, you get this definition, and it's a very restrictive definition, because it says that because of an injury or an illness, not only are you not able to do your own job, but any other occupation. You follow? So the degree of injury or illness must be substantial for you not to be able to do anything else. Okay? So they don't give you much latitude. In a lot of group insurance policies, and we'll talk about some of where you can buy some of these things in a second. Of course, in the interest of cost, right? Guess what? How they structure it? It's any occupation. And many people, and this is why I tell people that you've got to take responsibility for your own affairs. Okay, many of us just relegate this to our employers, and bury our heads in the sand, and everything is fine until something goes wrong, and then we find what we're up against. Okay, and hence the reason why these kind of sessions are important, because then you become aware of these things. All right. Okay. So where can you get these things? First place is through your employers. It's the most economical, because invariably your employers subsidize a portion of it, okay, the cost of it, and the cheapest way to get this through. However, the trade-off is that because the employer is paying for it, the benefits are taxable. Okay, it's a taxable benefit, unless they really do and depending on who sets this up, and if you really structure the paper trail, the paperwork right, so that the portion that you are paying is the one that's paying for the disability, right? Then you can say that that's how it was divided up. Okay. The paper trail has to be right, because if it's just a lump sum premium being paid, as far as Revenue Canada is concerned, it's taxable. You got a benefit, now it's taxable. The other thing that happens is you don't have much say. It's usually the human resources people who negotiate everything, and then it's all just sent down to you. You really don't have a say in customizing it, and like setting up the definitions and whatnot. The second, no control, and the second kind, associations. A lot of professional associations, instead of the employers going out and negotiating with the insurance companies to get clout, they cluster. Okay? POC is one of them. All the churches, the 1,100 churches in the POC, for all their pastors, they've negotiated a group insurance contract. Right? That's true in association. The medical association is another one. The dental association is another one. They negotiate it for their people. Again, the problem there is here it's non-subsidized, so the taxes, the benefits are not taxable, because it's the member that pays the premiums out of their own pockets. Okay, they usually through their association website they sign up for it, Nurses Association maybe, right? And they just opt for it. And because they are paying the premiums themselves, not subsidized by the employer, the benefits are non-taxable. Again, there's a bit of lack of control, because it's negotiated at a different level by the association itself, depending on the number of people they have in the organization and whatnot, and so you will lose some control there in customizing it. The other kind that you can get is through your creditors. Whenever you go get a loan, invariably they give you this option. Would you like to get insurance, right? They always ask you if you want life insurance because they just want to make sure that if you're no longer there, that their loan is paid for, is paid off. But usually, 95% of the time, this disability insurance should be available. Okay? And if you would ask them, they'll tell you. So what happens there is, if I've got a mortgage payment or car payment of $500, and if I checked off that I want the disability portion, they'll tag on a premium to my monthly payments. But if I become disabled, those payments are waived as long as I'm disabled. Okay? So that's what it is. Basically, what you're buying is a creditor insurance. Same thing with car loans. Same thing with credit card balances. Then the other place that you can get them is privately, and where you have the most control. You design it the way you want, you pick the definitions that you want, and this is where financial advisors come in. This is what they get paid for. Financial advisors don't get paid just, if all they're taking is an order, right? They've got a lot of work to do in structuring this right, okay? Because this is where it all happens. And because later on when things do happen, we want to make sure that, the client has the best thing possible in their circumstance. All right? And of course, in the private situation, it is completely non-taxable. So how much should you get? How soon should you get it? And how long should it go for? These insurances, disability insurances. So how much should you get? As much as you can afford. Okay, within your budget, of course, right? Without compromising other things that you need. Note that the maximum is up to 70% and integrated from all sources. Now, sometimes some people are not able to get it because of health conditions. Okay, they have pre-existing conditions and whatnot. For those people, the best place to get it is through your creditors. Whenever you are buying through your creditor insurance, the qualifying is less stringent than when you do it on your own. Okay, this particular situation, this individual in his mid-30s, whom they put him through the ringer to get this. They wanted to see his financial statements. They wanted to see his contracts. He was self-employed. They wanted to see his tax returns, his wife's tax returns. But it's good. Let them do all the due diligence that they need to do, get it out of the way. And if they want to come on the risk, then they come on the risk. But now we have it, right? But when you buy from your creditor, if you've ever sat down in front of a lender, they always offer it to you. It's basically 1, 2, 3, 4, 5 questions. If you're not dying, if you're not on a dying bed, you've never been, then they'll just give it to you. You follow? It's very less stringent. There's not a lot of underwriting involved, and because of the numbers that they have. If you deal with just one bank and all the bank's customers, right? So they keep it as simple. So it's an easy way to get it if you are having a problem getting it. Then also, in the private sector, which we do, there are what's called guaranteed issue, okay? And we just came across one recently, and I didn't even think that they existed, but it was there. What they do is it's a bit more expensive, but it's there. They'll insure you for 3 years, right? Up to 3 years. And in the sickness part, they had they called it 24-24 pre-X. That means to say that if you have a condition in the last 24 months, they won't cover you for that condition in the next 24 months. Okay? They'll cover you for everything else except for that condition. But starting the 25th month, it kicks in. They just have this period that they just want to make sure. All right? So how much should you get? You can only get up to 70% anyways from all sources, right? So try, look at what your employer is giving you. If through your employer you only got 50%, then you want to try to get the other 20% from somewhere else. Okay, look into the loan facilities that you have, and see if you can't get it from them. So that you see, if I need $3,000 a month and I'm disabled, and because my $1,000 mortgage payment is disability insured, and that is waived, that is very helpful. Despite the fact that I'm only getting 50% or 70% from my employer, I'm already on a reduced income. So as many expenses that I can eliminate, I want to eliminate, right? To alleviate the stress that's going to be there. So how soon should this start? Now, when you set up these policies, they have what's called an elimination period. 30 days, 90 days, 120 days, or 180 days, called the elimination period, right? Now, like a deductible on an auto policy, on a home policy, the longer the elimination period, the shorter, the lower the premiums, because you're taking on more risk. Now, what is the ideal? The ideal will depend on the size of your emergency fund. If you've got 6 months of emergency fund, then you can take 180 days elimination period. Why should you pay the higher premium, right? Because you do have the 6 months emergency fund available. All right? Now, how long should the payments continue? Typically, when you buy a disability policy, it'll go for 2 years or 5 years or till age 65. Rarely I've seen policies go up to age 70, but never beyond that, okay? And because this is the typical working lives of people, and we're trying to protect income here. So when you structure yours, again, the longer the period that you choose, the coverage period, the higher the premium, all right? So the cost is... So what I'd like to do now is... What I'd like to do is to round this off by showing you a video of a financial advisor in Calgary, Alberta. I thought it was very interesting because typically we show a video of someone on the other end of the table who did not buy it and, suffered all kinds of hardships because they did not buy it. This is a bit different take in the sense that this is from someone on the other side of the table who bought tons of it and then went through the same process. But both of them always think the same way, that it will never happen to them, right? So take a look at this, and
my heart attack, I guess, officially took place on November the 2nd, 2002. And when I first noticed something was wrong was in the evening of November 2nd. I had a very, very slight chest pain. I didn't think anything of it. Thought it might be indigestion. Like everybody thinks, it can't be a big episode of anything. It was something that I wasn't used to. It wasn't a real heavy pain, but it was on a scale of 10, maybe a 3. So I went to the Medi Center in Calgary and chatted with the doctor, and he said, your blood pressure's a little high, but not that bad, so I'm going to send you for some blood work. I'll give you a call as soon as I find out what the results are. And so anyway, that afternoon, I'm downtown in a big office building, and my phone rings. I pick it up, and hello, Gary, it's Dr. Corley calling from the Medi Center. Listen very, very carefully. We've got your blood results back. You're having a heart attack right now. Don't do anything. Call an ambulance. Don't drive. And good luck. At that moment, I was hoping my clients would arrive on the scene because I could say to them, look, I can't talk to you right now. I'm having a heart attack, but I'll see you as soon as I get out of the hospital. And that actually raced through my mind, and because frankly, I was scared. And I had no idea what this was all about, because this was not going to ever happen to me. It happens to everybody else, but not me. I thought, boy, what a way to go. Of all the things I've done in my life, this is it. And, could I die from this? And all that's racing through my mind. And then I kind of went into another kind of sphere. And I thought, well, it's been good. And I know my will's current. I have a power of attorney in case I don't make this. I've got, more than enough life insurance in terms of my wife and my 3 kids, and I never even thought about critical illness or disability. I just thought of, the catastrophic thing. So anyway, I thought, this is okay. I know one thing that I wasn't worried about. I wasn't worried about money, because I had as much disability income as I could buy and as much business overhead as I could buy. We've got a staff of several people and, rent, et cetera, et cetera. I mean, my share of the overall expenses is several $1,000s a month. So, I would rather spend a few dollars and put the risk on somebody else rather than dipping into my savings. I had more than enough critical illness just in case I wanted to take advantage of best doctors. And so I knew that I wasn't worried at all about that aspect of it. I think that was a big plus for me in terms of my recovery time, because I didn't have to race to try to come back to work because I had to for money reasons, because I didn't have any money problems. My experience with the claims process was terrific. When I was going through the recovery stage here, I'm out in Pritis, it's the winter time, blizzardy, miserable. The phone would ring and be Amitha calling me, just to say, you know, how are you doing? What are you doing? She would call me a couple of times a month just to talk about how things were going and any problems with any of the paperwork, and she constantly kept me in the picture. She was a great stress reliever. It gives you a lot of freedom to do things that you know that you have to do without the worry of money. I really didn't have any financial concerns whatsoever, none. Not having financial worries is unbelievable. The peace of mind is wonderful, and I guess in a nutshell that's what it was for me. And I'm so glad that I went in and I bought the financial instruments that I did, and I bought them for a couple of reasons. I mean, I knew that I couldn't recommend them unless I owned them. I knew that. And I also knew that it was good for me, although it was never going to happen. Wasting all of this money without a waste. It was a deflection of a little bit of money to put huge risks on somebody else, which is what I did at the end. And it was, and I won, thank God.
All right, that brings me to the end of the disability insurance.